I want to begin by considering how we might measure economic activity in terms of a flow of production. Now, in a modern industrialised economy, production of a final commodity is often the result of a multi-stage process. To illustrate this, I'm going to take a production process with 2 stages, though in reality there might be many, many more. But this will serve to illustrate an important point. So think of the following situation. We'll have 2 firms. Our first firm, the first stage of the production process, is in the business of producing what we'll call an intermediate good. An intermediate good is not something that's purchased by consumers, it's something that's purchased by other firms who use that intermediate good as an input into their production process. So let's go back to our first firm. Firms are in the business of production, and in order to produce, they require what are known as factors of production. And in macroeconomics, we take a very aggregate view of this, and we assume that there are just a small number of these factors of production that are important. Broadly speaking, labour and capital. Now, labour's easy, that's just the workers, that's you and I. Capital is something a little more complex, a little more subtle, and the word capital has a very precise meaning in macroeconomics. When you hear a macroeconomist talk about capital, what he or she is talking about are the physical, tangible assets that firms use in order to produce output. It's the plant and equipment, the buildings, the machines, the production lines, the computers, all of those things that you can touch, physical, tangible assets that in combination with labour yield output. So our first firm is bringing together labour and capital, and in doing so producing this intermediate good. The intermediate good is then purchased by firm 2, our second firm, the final stage of this 2-stage production process. And firm 2 has its own labour and its own capital, which it now combines with that intermediate good to produce the final good, and it is the final good that is purchased by consumers. Now, when you look at it this way, as a multi-stage process, and we think about how we're going to measure the flow of production in the economy, well, in this case, there has been 2 instances where production has taken place. We've had the production of the intermediate good and the production of the final good. So why not simply measure those 2 flows to try to determine what the gross domestic product will be, the economic activity, as a result of this 2-stage process? Well, if we did that, if we measured the intermediate good and then measured the final good, you would actually find that you have a problem known as double counting. And the double counting problem is that if you did it this way, measured the production flows at both stages, you would end up counting the intermediate good twice. And that's because the price at which you would value the final good already reflects the cost of the intermediate good. So if we measured production at both stages of the production process, you would be counting those intermediate goods twice. So when we measure economic activity, thinking about it as a flow of production, we ignore the production of the intermediate good because we're going to pick it up when we value the production in terms of the final good. Let me give you another example. This time we'll have a few more stages. Let's think about the production of a loaf of bread. Now, loaf of bread, something we might purchase every day. Actually, the production of that final loaf of bread is the result of a number of distinct stages of production. First, there's the wheat coming from the farm. Let's suppose that the wheat farmer sells wheat for $1.80. We'll make it easy. There are no intermediate goods here. This is the first stage of the production process. And so we'll talk about value added. Now, value added simply means what has happened to the value of the resources as a result of this production stage. Here, the wheat farmer has taken resources with no value and by selling the wheat on has produced resources with a value of $1.80. The value added at this stage of the production process is that $1.80. There'll be a second stage now where the wheat is sold to a flour mill. The flour mill purchases the wheat for $1.80, so the wheat now becomes an intermediate good for the flour mill. Let's suppose that the transformation of wheat into flour means that that flour can be sold for $3. This stage of the production process has therefore value added to those resources by $1.20. Resources that came into the flour mill valued $1.80 have now been transformed into resources valued at $3. The next stage is the production of dough. That will require flour, so flour becomes an intermediate good purchased for $3. The dough will be sold, let's say, for $4. So this stage of the production process has added value of $1. And then finally, the bakery takes that dough, turns it into bread. Having purchased the dough for $4, and let's suppose sells the loaf of bread for $4.40, and therefore the value added at that stage, 40 cents. Now, I want to focus on this column, the value added column. This is looking at production at each stage purely in terms of value added. In other words, we are taking out the cost of the intermediate goods at each stage. In doing so, we avoid the double counting problem that we identified in the previous slide. If we add up all of that, all of those value addeds, if we took the total value added by adding the individual value addeds from each stage, we get $4.40. And in fact, the GDP that has been created as a result of this multi-stage production process will be at $4.40. By adding up the value addeds for each of these production stages, we have a measure of economic activity that has occurred over this time period, thinking about the economic activity as a flow of production. So one way of thinking about gross domestic product, if we want to think about it as a flow of production, is that it's the sum of value added. What about expenditure? Here we have to be very precise about the type of expenditure we're talking about. Broadly speaking, in macroeconomics, there are two different types of spending, two different types of expenditure that we are going to recognise. The first represents expenditure on final goods and services where those goods and services have been purchased to meet immediate needs. For example, the food that you buy is expenditure to meet an immediate need. Broadly speaking, any expenditure that takes place to meet an immediate need is known as consumption. Now, in the macroeconomy, we are going to identify separate groups or sectors and think about what their consumption expenditure is. The first of these sectors is the household sector. Now, the household sector is you and I. And here, the consumption expenditure is on what are called non-durables. These are things like food that are purchased by households to meet an immediate need. It's going to be important for us to keep track of where that consumption expenditure comes from. Is it expenditure on domestically produced goods and services, or is it expenditure on imports? The government is our second sector. Government is a very large sector in the economy, and so we keep track of any expenditure that it makes to meet its immediate needs. And again, we need to recognise that that can be expenditure on goods and services that are produced within the domestic economy, or it might be the government purchasing those goods and services from suppliers in other countries, imports. And there's a third important sector, the foreign sector, because foreigners are also purchasing. They're also undertaking expenditure, and what they are doing is purchasing a country's exports. So we have three sectors in the economy that engage in consumption expenditure, that are engaging in the purchase of goods and services to meet immediate needs: household, government and foreign sectors. But there is a second type of expenditure known as investment expenditure. Investment expenditure is different. It's where the expenditure is being undertaken not to meet an immediate need, but to meet a need that will exist at some point in the future. Again, we're going to divide this between sectors. For households, investment involves expenditure on what is known as durable goods. An electrical appliance, a stereo system, for example, is a durable. It's something that is purchased now, but it's going to continue to meet needs going into the future. Once again, we need to keep track of whether that expenditure is on goods and services made domestically, or is it indeed an import from another country. Firms become important here. Firms don't undertake any consumption expenditure. Their expenditure is all in the form of investment, because when firms purchase goods and services, it's always going to be with a view to how will this relate to production going forward into the future. Now, firms' investment consists of purchases of plant and equipment, but also inventory of unsold stock, which I'm going to come back to shortly because it's a bit tricky, I think, to see how this fits in. Basically, what we're saying here is that a firm has produced some stock but not been able to sell it in the current period. It's going to hang on to that stock, and the future need that meets is that unsold stock is available to meet demand at some point in the future. So it satisfies our definition of investment, that is, it's something that's going to deliver a benefit or meet a need at some point in the future, and for that reason we include it as part of firms' investment. Again, you might want to keep track of whether the particularly plant and equipment that is being purchased is being sourced from domestic suppliers or from other countries. The government also engages in investment expenditure. Government buildings, for example, is an example of something where the government is spending money not just to meet an immediate need, but a need going into the future. So we have these different categories of investment expenditure. Consumption, meeting immediate needs; investment, meeting needs in the future. And the other thing I want you to take from this slide is the idea, and we're going to use this over and over again, of dividing the macroeconomy into a small number of distinct sectors. We'll come back to this shortly. Let's go back to our loaf of bread example. Now, we've seen how by looking at value added at each stage of the production process, we obtain a measure of GDP that can be interpreted as valuing the flow of production that takes place over a particular period. Have a look at this number here though. This is the cost of the final loaf of bread. This represents the expenditure on the final good, not the intermediate good. And as you can see, and fairly logically, that expenditure gives you the exact same answer as the summing together of all of the value addeds. In other words, if we wanted to think about economic activity not in terms of the flow of production, but in terms of the flow of expenditure on final goods and services, that is another way of measuring gross domestic product. And as you can see, what this is telling us is that because of the way we value production using the value-added approach, that what we call the flow of production is exactly the same thing as what we will call the flow of expenditure. Expenditure and production both give us gross domestic product if they are measured appropriately. Now, I'm going to make some assumptions here that we are going to use pretty much throughout the course. Now, you're going to see a lot of assumptions in this course, as indeed you do in any look at macroeconomics. This relates to what I was talking about in our first lecture, the building of models. The fact that we're not trying to create exact replicas of the economy in our analysis, but we wish to work with simplified representations of the economy that enable us to focus on key fundamental forces. So these assumptions are not meant to conform to reality. They don't. What they're meant to do is to simplify our analysis so that we can then focus on the key aspects of the real world that are going to be important for determining macroeconomic outcomes. So our first assumption is this. We're going to assume that it's only firms that engage in investment. Now that's not true. Households buy durables, governments engage in investment. It's just going to make our life much easier in terms of how we model the economy if we restrict investment to firms. It's not going to do any harm to our analysis. If we were to have households and government also doing investment, it's just going to complicate the models we work with without actually adding much in the way of the analysis. So firms are the only sector that engage in investment. And for similar reasons, we're going to assume that households are the only sector that purchase imports. Again, you don't have to make that assumption. We could work with a model of the economy in which government and firms both purchase imports, all that's going to do is make the analysis more complicated without actually adding any significant insight. So we'll restrict imports to the household sector and we'll restrict investment to the firm sector. And pretty much we're going to maintain those assumptions throughout the rest of the course. So we've seen that GDP can be thought of as a measure of the flow of economic activity, and we've seen that we could measure that using either the production approach, adding up all the value addeds, or the expenditure approach, looking at the expenditure on the final goods or services. You end up with the same answer, so GDP is equivalently a measure of expenditure or a measure of production over a time period. But it's also a measure of income. Let me explain. Let's start with firms. Firms are producing the output in the economy and then selling that output. And ultimately, that's the source of income in the economy. Income is derived from the production and the sale of output. Now think about the sales receipts that a firm gets as a result of selling its production. And ask the question, what do firms typically do with those sales receipts? Well, some proportion of those sales receipts gets paid out. It gets paid out in a variety of forms, as wages to its workers, perhaps interest on any loans that have been taken out in the past, rent, maybe the firm is renting its business premises, dividends which flow to shareholders, and any tax that the firm may owe to the government. So the sales receipts that come into a firm, some proportion is going to flow out of the firm as wages, interest, rent, dividends, and tax. What happens to the rest? The rest gets classified as either retained earnings, so these are sales receipts that the firm holds on to, but firms also hold on to some funds as an allowance for what is known as depreciation. Now, depreciation refers to the fact that plant and equipment wear out through time and need to be replaced. And often this is fairly predictable, so firms hold back some of their sales receipts as a depreciation allowance, enabling it to replace worn-out plant and equipment as the need arises. Now, retained earnings and this allowance for depreciation are collectively known as business saving. What about the households? We're going to assume that the wages, interest, rent and dividends that firms pay out all flow to the household sector. And in combination, they constitute the household income. Now, a proportion of that income can be used for consumption. What's not used for consumption is available for two other purposes. It can be used for household saving, or it can be used to pay taxes. The government sector receives taxes which are paid by firms and households. You can think of that as being the government's income. Out of that income, the government undertakes its expenditure, and there may be a difference between the taxes that the government collects, remember those taxes come from both firms and households, and the amount of expenditure it undertakes, and this we will call government saving. Now what you're looking at here, T stands for the total value of taxes the government collects, G is this expenditure. This is known as the budget balance. And if taxes over a time period are greater than government expenditure. That's known as a budget surplus. Should it go the other way, where government spending exceeds taxes, that's known as a budget deficit. If the government is running one of these surpluses, it's actually adding to its saving. So the main point I want you to get from this slide is that the ultimate source of income comes from production. It comes from firms selling its production, receiving sales receipts, paying a proportion of those receipts to households, which then becomes household income, paying some of those receipts as tax, which flow to government, which become part of government income, and government income also comes through household tax payments.